Self-directed IRA is an account where you control what you invest in. Now, a lot of accounts are advertised and promoted as self-directed. All the big brokerage houses have them. And what they mean by self-direction is that you can change from a menu, pick from a menu of stocks and bonds and mutual funds and cash instruments, listed securities in short. And that's what they're set up to do. And they're great places to have accounts. I have accounts at Vanguard myself. The difference is that we're set up along the same lines, but we're able to handle alternative assets. These are assets that are not listed, like apartment buildings or vacation boats, or we've got a guy with a dump truck in his IRA because it generates revenue. So we handle the alternative asset side, and that's true self-direction because it allows you to invest in what you know.
Hi, Adam Gower here, founder of GowerCrowd.com and host of the real estate reality show at youtube.com/GowerCrowd and on good podcasts everywhere. Today's episode is a continuation of our series on the tax benefits and implications of investing in commercial real estate, particularly through syndications. My guests are from CamaPlan. Now, what CamaPlan do is they provide access to self-directed IRAs, and it's a very interesting aspect of the investing world. Is this idea that you can manage your own IRA, your own retirement account, essentially. And the reason that I was particularly interested in talking to these guys today was because when I went to my accountant. Oh my goodness. In fact, the motivation for this entire series on tax benefits and implications of investing in real estate, she told me that I shouldn't do an SDIRA because of some clauses or some parts of the law that make them null and void. I mean, she made it sound like it was a huge mistake to even think about it. Two things: UBTI and UDFI. UBIT. UBIT and UDFI. So I'm going to let my guests, Joe Fulvio and Will Mucker, explain exactly what those acronyms stand for and how, in fact, they don't nullify the benefits of an self-directed IRA. If you've not already done so, do please sign up for our weekly newsletter at GowerCrowd.com. Comes out once a week. You can always unsubscribe. And we're actually going to be launching some very interesting educational products in the coming weeks. So definitely tune in. Definitely sign up so that you get access to that as soon as it comes out. Okay. That's all I have to introduce my guests. Again, Joe Fulvio, Will Mucker of CamaPlan, who are going to be talking about the self-directed IRA, what it is, how it works, how it can benefit you, and why your accountant may not really understand everything that there is to know about this incredible resource. Here they are. Joe, Will, thanks so much for joining me today on the show and on the podcast. It's great to have you. I'm fascinated by SDIRAs, and we're gonna trip over something. Because I tripped over them some time ago, which is really why I wanted to talk to you today. But why don't we start at the very, very top? What is a self-directed IRA?
Self-directed IRA is an account where you control what you invest in. Now, a lot of accounts are advertised and promoted as self-directed. All the big brokerage houses have them. And what they mean by self-direction is that you can change from a menu, pick from a menu of stocks and bonds and mutual funds and cash instruments, listed securities in short. And that's what they're set up to do. And they're great places to have accounts. I have accounts at Vanguard myself. The difference is that we're set up along the same lines, but we're able to handle alternative assets. These are assets that are not listed, like apartment buildings or vacation boats, or we've got a guy with a dump truck in his IRA because it generates revenue. So we handle the alternative asset side, and that's true self-direction because it allows you to invest in what you know.
So what are you then? What is CamaPlan? Are you is it called a custodian, or what exactly is your role?
Yeah, we're a neutral third party. The IRS requires you to have a domicile for your IRA. You can't hide it under your bed. You can't keep it in a checkbook somewhere. So we're no different than Schwab or Fidelity or Vanguard in the sense that we keep the records and we keep a recording of all the transactions that occur within the IRA because you're granted a tax deferral or tax-free status in the case of a Roth IRA, and we account for that. So we file documents with the IRS, and we provide those documents to our clients and their accountants or tax prep specialists.
So the idea of an IRA, kind of basically any kind of IRA, is that you can, there's two different kinds. So we're definitely getting into the weeds a little. There's two different kinds. One allows you to put pre-tax money in. So you put money in and then you can deduct that from your ordinary income that year, right? And it grows tax deferred, I guess, throughout its life.
Correct.
And then the other type is you pay your taxes and then you invest in the IRA. I think it's the difference between a Roth and a regular IRA, right? Those are the basic difference. Is that, am I getting that right or wrong?
Correct. You nailed it. You nailed it. It's basically they want to encourage you to save for retirement. So they'll give you a tax break during the year in which you make a contribution to your IRA. Those are tax deferred IRAs. They're called traditional IRAs. There's a couple of other versions of them. The other is the Roth IRA, where they are also encouraging you to put away for your retirement, but you get to keep everything. You don't get the tax break. You get to keep everything on the back end. So we liken it to paying for the seeds versus paying for the entire crop. So in the case of the tax deferred, when you start removing that money from that account, you will share it with the government. You will be taxed at the rate at which you are taxed in the year that you withdraw that. The thinking there was that in retirement, your income would be lower and you would be in a lower tax bracket. Right. Taxes keep going up no matter. So those are the differences, but you've got it in a nutshell.
Right. Okay. And then the other one is the 401k, right? So the 401k, how does those are also savings plans that are encouraging retirement, and that is also deductible when you contribute to a 401k. That is also deductible from your ordinary income in the year you make the contribution, right?
Correct. And there's also a Roth 401k. So you can do the same thing in 401k that you can do in a traditional. The biggest difference from a first encounter would be that the Roth are both the 401ks enable you to make larger contributions, and I think that's what makes them attractive.
Right, that's the point, isn't it? That each year there is a limitation on how much you can put into in aggregate all of these together. But you can put more into a 401k than you can into an IRA, into a Roth. There's a limit, right? So there's a limit based on what income typically, is it?
There are income limitations.
Age, there's a few things, right?
There are income limitations on all of these things, and again, we always have this. It's almost like a tick. Consult your tax specialist or your accountant because it's going to be different in everyone's case. But yes, there are. We have a table at the website that delineates the income brackets for contributions and deductions, and they are within ranges, and it's going to be different for every taxpayer.
Right, and it changes every year. So
it does.
So here you have a self-directed IRA. So if I wanted to, could I set up a self-directed IRA and de novo, like brand new? So I want to set up one today, and how would I fund that?
There's three ways you could fund it. Two of them are essentially the same, when it's said and done. You set up your IRA, it takes about 20 minutes. It's like opening a bank account anywhere else. You'll put in a lot of personal information and we'll check that to make sure you're not wanted by Interpol or you're not running guns. Mm-hmm. And then once the account is set up, you can transfer money over from similar accounts at other institutions. If you have an IRA, a Roth IRA at Schwab, you can transfer that to your Roth IRA here. Same thing for traditional IRAs. 401ks are called rollovers, but it's a distinction without much of a difference in the sense that we're just moving money from one institution to another. So the other way that you can fund the accounts through contributions. So the annual contributions you make plus money you bring over from other accounts.
Right. So the limitations, if I was to set up an SDIRA today and not fund it with existing IRA or 401k accounts, I would be limited to how much I can put into that based on how much I could put into a regular IRA or a regular Roth. Is that correct? That's my limitation. So I don't know what it is. Not that much, few $1,000s, right?
Right. It's I think this year, Will correct me if I'm wrong, it's 6,500
Right.
with a $1,000 catch up if you're age 50 or above. And
Okay.
next year it goes up
So
to 500,
basically
$500.
minimal. It's basically.
It's not a
Uh,
place to begin to build in order to invest. But I've got something I can share with you that'll allow
sure.
you to do that with a small amount of money. Yeah.
Mhm. But okay, but I want to get to the syndication, the real estate syndication world. In the real estate syndication world, typically you're looking at a minimum of $25,000 to invest in a syndication. Minimums can go up to 100, they can go up a lot higher. So to use a self-directed IRA, you probably want to be transferring money from a directed IRA, something that's managed by somebody else with an institution somewhere, Schwab or whoever it is. You bring that money over, it becomes self-directed, and now you can invest in a dump truck or whatever that earns income for you, or you can also invest in a real estate syndication or in multiple real estate syndications, right?
I'll let Will, why don't you grab that one?
Yeah, so more commonly than not, they're probably one of our most common assets here at CamaPlan. More commonly than not, they're going to have a subscription agreement, a private placement memorandum, and then on that subscription agreement, and this goes um, with all of the investments. The investor itself is not you as the account holder, it's the IRA, which is a separate entity from you, similar to a trust in the eyes of the IRS. So when you go to invest into that private placement, that real estate fund, that subscriber on that subscription agreement isn't you. It's going to be something along the lines of CamaPlan, FBO, which stands for benefit of your name, IRA or Roth IRA, SEP IRA, whatever type of account you have with us. And then you initial next to the signature line for that IRA that lets us know that you've read and approved of the agreement. And then we sign on behalf of the IRA as third-party administrator and send the funds over to that investment provider, provided the supporting paperwork.
Right. And it works the same way as an IRA, doesn't it, Will? In the sense that any gains during the ownership or while it's inside the SDIRA they roll over tax deferred, right? Unless it's a Roth. I think that was the one, right? If it's a Roth and you're putting post tax capital into it, then you get to keep it all. But for the most part, you're deferring it until a later stage and you're not paying any capital gains while it grows and you're not paying any income tax on it inside the SDIRA. Right. So I went to my accountant. This is why you're on the phone, Will. And I said, here, I want to invest in an SDIRA. I want to invest in a syndication using SDIRA. And she said, don't do it. It's not a good idea. And this is why. So I'm going to throw out 3 acronyms that I would be grateful if you would do 2 things. One, translate, because I can never remember what they stand for. Unregistered business income something. That's UBIT. UBTI and UDFI, but there's another one with a B. Oh, it has got a B in it. So anyway, that's what she said. She said, look, if you invest in a syndication that takes on debt, which they all do, I mean, I know one that doesn't, but 99.9% of syndications take on debt. You are going to have to pay tax. Your IRA is going to have to pay tax. So why bother? Okay, so that's my question for you. First of all, what is UBIT, UBTI, UDFI? What are all these acronyms? And do I have to pay tax? Why is it still a good idea to invest in an SDIRA?
Yeah, absolutely. Great question. So first and foremost, Joe said this, I'm also not a tax professional. I don't give any tax advice. Everything I'm going to talk about is through the scope of CamaPlan, the custodian, what we tell our clients to look out for, but also consult with your tax professional. So, in some instances, it's not very common, but in some instances, when you do these investments out of the IRA, you may run across these taxes. UBIT, sometimes referred to as UBTI as well, or UBIT, and UDFI. So UBIT is the overall umbrella. UDFI is under that. Some people will say UBIT, and they're also talking about UDFI as well. So UBIT stands for Unrelated Business Income Tax, or Unrelated Business Taxable Income. So that's when the IRS deems that you're running a business out of the IRA. The two most common methods I see that trigger these, or trigger UBIT specifically, are flipping properties within the IRA. What the IRS says their definition of a flip is, they'll never say. Some people say if you hold the property for a year, you're okay. Some people say if you do this many a year, you're okay. But those people are not the IRS. And again, the IRS most likely never say. So you want to talk it over with your tax professional. The IRS may deem those properties that you're flipping as inventory in and inventory out. And if they do deem that, then you would be due those taxes. Another
Why
way
is that? Why is that? Is that because it's not a security? Like, why is that? Why don't they like that?
So I think it's because IRAs and retirement accounts are supposed to be passive investment entities. And these tactics that you're using are outside of what the IRS originally deemed the IRAs and 401ks to be for.
Okay.
So they say you're going into activities that the IRAs aren't usually for. We want you to pay a cut from the income you're earning from those activities.
So you're running a business inside the IRA. That's not what this was designed for. Business occurs outside, and passive income and investments and savings, that's what occurs inside. That's passive. Okay.
And if I can jump in, that another reason is they don't want you competing unfairly with real businesses because you're inside of a tax protected vehicle. And the same sort of thing applies to nonprofit organizations who have tax benefits that they can't use against when competing with taxable entities. So
got it. Okay, that makes sense. Okay, so that's UBIT. Okay, go ahead. Keep going, Will.
Yeah, thank you. And that's one instance that UBIT specifically could be triggered. Another instance that I've seen some clients run into for UBIT specifically is developing on undeveloped land. So your IRA can go out and purchase a plot of land. Now, if that IRA pays a contractor to develop on that undeveloped land, the IRS says, hey, you're running a development business, you're going to have to pay this income tax. And then on the other hand, you have UDFI, which stands for Unrelated Debt-Financed Income. Now, if you don't have the entirety of the funds available for investment or an expense your IRA needs to pay for these self-directed investments or alternative investments, your IRA can receive financing for those investments. It can't be through your traditional financing. It has to be through what's called a non-recourse loan. So what a non-recourse loan is, for those of you who don't know, is the loan isn't being made to you as the account holder. So one, you can't personally guarantee it. And in addition to that, if the IRA were to default on a payment on this loan, the only recourse the lender has is to go after that specific property, specific account the loan was made to. Usually they'll go after the property. They can't go into your other accounts at CamaPlan that the loan was not made to. They can't go into your other accounts outside of CamaPlan, and they can't go after your personal belongings. So because of these restrictions put on the lender for these loans, their requirements are usually a little bit higher than your traditional financing. Now, if you go about and you get one of these financing options through these non-recourse loans, that's when the unrelated debt-financed income comes to play. Now, for both of these taxes, the UBIT and UDFI, one of your earlier questions were, why do people pay this? Why are they okay with paying this? One, it's not very common. In some instances, you may run across it, but in the instances that you do, you're still using that account to grow your retirement account quicker than you would be with some of the other investments that you may be making. And if you were making that investment outside of the retirement account, you're going to be paying taxes anyway. So a lot of people that ended up paying these taxes are okay with it because it's a measured risk that they took, and they accounted for those taxes when they were doing their due diligence on the investment. So yeah, those are the things that could trigger these. And then some funds may take on UBIT. Some have ways to structure it where they don't incur this UBIT tax. But it's really dependent on how those structures, those tactics, I'm not too familiar with, though.
Okay, so let's talk about real estate syndications. And this is when people invest in a syndication. And that's what I was considering doing, was investing in a syndication. What you've described is different, it seems, than investing in a syndication. Does UBIT, in your experience, and understanding this isn't tax advice and CYA, you got to talk to your accountant and financial and blah, blah. Everybody knows that, right? We'll make it clear third time. But in your experience, when somebody invests in a syndication, so they are actually passive, they're buying securities, right? They're buying a share in a company through their SDIRA. That's essentially what they're doing. They're buying securities. That's why it's regulated by the SEC. They're buying securities. So when they do that, if those securities are to invest in a piece of real estate, in a real estate project ground up, or a value add deal, call it a multifamily ground up or a multifamily value add deal that takes on debt, does that fall under UBIT and UDFI in your experience? Sounds very different from what you just described.
So in some instances, yes, they could take on debt depending on how they've structured it and the entities that they use.
You might hang on, they, who is they?
Sorry, the investment provider, the syndicator that you're working with.
Okay. So they'll go out. Let's just pick an example. Somebody goes out and buys a $20 million apartment building, and they take on $15 million of debt, and they raise $5 million of equity, $100,000 at a time. So I'm out there and I say, I'm going to invest 100,000 in this. I like that. So now I'm a limited partner. I buy a certain number of shares, 1/20th or whatever the number is of the shares, whatever it is, 10, what is it? 10, I forget, whatever, 1/50th of the total ownership of the of this property. But I'm passive. I'm a limited partner. I'm not taking on debt. It's the issuer who is taking on debt. Does that pass through then to UDFI, unrelated debt-financed income?
That's a great question. Usually when it comes to these questions, what I tend to lean on is when you're working with these syndicators, they are aware that they're taking in funds from self-directed IRAs, and they've made it, they've built it into their system. They are aware whether the way they structured the entity, the investment, and the different entities they use. Some people will use one LLC and get financing to that, traditional financing from that, and another LLC or entity to receive financing like from self-directed IRAs. And depending on how it's structured, they may be able to avoid that UBIT. Again, it's a little bit above my head when with those specific questions, but they're working with tax professionals on their end when they're structuring these deals to know whether or not their investment is going to be triggering these taxes potentially.
Okay, so we are in the weeds, and I do appreciate this is very technical, but this is
I can add one thing is that we're seeing more and more investment opportunities that are labeling themselves as UBIT blockers. In other words, they've accounted for this. This is something you can do in due diligence. Simply ask the syndicator, what do you do with UBIT? And it'll either be, well, we take care of that over here within the, within the structure of the business that we're running or the property that we're developing, and that doesn't affect. So it's a good due diligence question to ask.
Right, but a UBIT blocker, and it's certainly something you want to ask. But so understanding that this is very technical, both of you, Joe and Will, and it does depend on circumstances and on structure and I think. can you define what it is that you're looking for? Is it, for example, that the investor somehow is tied to the debt? I mean, is there a trigger somehow inside that you would be looking for? Maybe even the syndicator doesn't even know. I mean, they don't even know, but you could look at it and you say, oh yeah, look, I can see that the way they've got their debt structured, it's over there, not over here. And I'm not related to it. I mean, for example, limited partners have no responsibility for debt at all. It's always the general partner. That's why it kind of confuses me. How can it be? How could they? How could UBIT actually, or at least unrelated debt financed income, be relevant if you are investing through a syndication?
So great question. I know one indicator, and I need to get the research on my end to say what does indicate that these taxes may be deducted from the IRA and what doesn't. But one indicator is whether the fund that you're investing in issues you a K-1 or a 1099 with those investments. And there are indicators within those documents that may point towards the possibility of you paying those taxes. Now, I forget off the top of my head which one is more likely to have those taxes paid. Again, I don't get too deep into the tax stuff. I can get that answer for you. What's more likely to do to trigger those taxes? It's not always as easy as that, but I can get that answer for you.
Okay, I would say that I never heard of a 1099. They're always, in the syndications that I work on, always K1s. It's always a K1 that you get at the end of the year. They pass through losses, they declare whatever income there is. It's not certainly not a 1099. Yeah.
Okay. Yeah, and
I think a lot of it has to do with the structure. I mean, you're talking, Dr. Gower, about limited partners versus, say, shareholders in a 506c arrangement, or unit holders in a fund, or whether
Well,
you're simply
whatever they are shareholders. I mean, whatever term you want to make. But anyway, look, we're getting a little bit
we're
too
getting
weedy
this
here.
is real
So
talk.
I'll tell you what, let's step beyond this now. Let me ask you, CamaPlan. Let's wrap up. Normally we'd start with this conversation, but let's wrap up with, all right, tell me about CamaPlan. How big are you? How much? Just tell me a little bit about, your scale and the typical kind of client. What do people come to you for? And they are I know you've told me already, but to repeat now, I do know that a lot of your customers or clients are investing in real estate syndications, aren't they? So tell me a little about CamaPlan and general investor or client avatar.
We have 7,500 clients. We have over 1.1 billion in assets under management. We're a heavy real estate house. The company was founded by third generation real estate investors, and they're saying it. They say they found the company by investors for investors, and that's pretty much true. And when I say 75%, I mean not only direct purchases and holding a property, but also all of the ancillary involvement you can have with real estate. As far as mortgage notes, fix and flips, temporary bridge loans. Some of them come in the form of LLCs and LPs, and name a corporate structure, and it's real estate comes packaged in it. So roughly 75% of our business is there. About 3/4 of we probably have a quarter to a fifth of our investors are accredited, so they operate at a very high level. They're very savvy, and again, very real estate oriented. But we noticed a trend, and that those who started out with private lending, got into real estate, are now looking at private equity and as the next step in their sophistication. We also have a lot of people that come into this form of investing from real estate. They're agents, or they're finance, or they're involved in lending, or they're with banking, and they come in as clients, and then they begin to develop a taste for packaging deals, and maybe they do friends and family at first, and 5 years later they're doing a 506c, and they've become their own fund. So
Very interesting. All right. Any last words about that you would like anybody to hear about SDIRAs and all this kind of really tight tax stuff we've been talking about? I do need to bottom this out there.
Will.
Yeah, absolutely. You said in the beginning of the presentation that when you went to your tax professional, your accountant, they said don't go anywhere near these things.
Yes.
So the fact is, I believe the number is still accurate. About 3% of the country knows and utilizes self-directed IRAs, and it isn't because they're bad. It's because the education isn't there, and that's not just by the investors. That's the professionals, the tax professionals. That's some of the attorneys. They don't know about this stuff. I think it's been allowed since the 1970s, but only then were the big banks allowing high net worth individuals that had millions and millions of dollars in their retirement accounts do these sorts of investments. Not until recently, like companies like CamaPlan popped up, that it's been made available to pretty much anybody with a retirement account. So do your own research as well. Not saying your tax professional doesn't know anything about it. They might not have all of the different angles that you need to look at when you're making this decision. So don't just go to your tax professional and say that's done. Don't just go to your financial advisor and say that's done. Like you're making any of your decisions, seek out multiple different angles before you come to your final conclusion.
Will Mucker, Joe Fulvio. Am I pronouncing your name right? Fulvio?
Correct.
Thank you, CamaPlan. Thank you so very much for joining me on the show today. I really appreciate it.
Enjoyed
Thank
it,
you
Dr.
for having
Gara.
us.
Thank you. Yeah.
All right, that was Joe Fulvio and Will Mucker of CamaPlan talking about self-directed IRAs. Right. I am actually going to be producing a book on this topic. So by the time you hear this, it may already be out. It may not be. But check out gowercrowd.com and I'll put it somewhere probably on the homepage there. And covers all these episodes that I've been putting together on the tax benefits and implications of investing in commercial real estate. And it will be the ultimate resource. Sounds a bit corny, but it really will be the ultimate resource to understanding all the different options available to you. Joe, Will, thank you so much for joining me today. It was a pleasure meeting you. And thanks for spending your time with me on the show today. And dear viewers, thank you too for having joined us today. I hope you learned something. It is interesting, isn't it? These different aspects of how you can save tax and build for retirement. Oh my goodness, you know, I've not only gone grey, but I've most of my hair's already falling out. Definitely feeling quite mortal these days. So planning for retirement, not something I did with any gusto. I just figured I'd figure it out. Well, now is the time to figure it out, at least for me. And I do hope that these episodes on tax savings and how you can plan for retirement, essentially, the tax code as it applies to real estate investing, is helping you a little bit along your path as well, whatever that might be. Okay, that's it. Thanks again for joining me. And until next time, this is Adam Gower signing off.